Hey Finance Fam, back with you again with a video today where I'm going to react. But this time, I'm reacting to investor portfolios that were sent to me via my Instagram DMs. So, let's start, shall we? Okay, first of all, I'm going to say that this is not financial advice. This is for entertainment purposes only. I do not know any of these people's full financial situations. They are not clients of mine. I have not been paid by anybody. These are literally just DMs that I am going to see what they're invested in and I'm going to react to it. And hopefully you learn something that you can take to your own portfolio, maybe, you know, have something that you can research a little bit deeper and think about your portfolio allocation a little bit differently after watching this video. So let's begin. So the first portfolio that I received was from a gentleman named Corey, and I'm going to just keep it first names, not going to show handles or anything like that because I just want to keep everybody anonymous and safe. But this person has an overall allocation of 60% stocks, 15% cryptocurrencies, and 25% cash. Okay, so we're going to dive into each one of those. We're going to dive into his stocks, we're going to dive into his crypto, and we're going to dive into the cash position, and I'm going to just touch on that. So the first thing is going to be, we're going to start with stocks, my fave, right? So he's got a 45% S&P 500 allocation, a 45% total world allocation, so not just US stocks, but also some international stocks as well. And then he's also got individual stock picks ranging around 10% of his portfolio. So he's taken some stocks and picked them. I don't know all of those stocks, but let's just start with that. You know, overall, I like that he has an allocation to individual stock picks in his stock portfolio. I do that myself. I do both passive investing with ETFs and also active investing with picking stocks. I do believe, and this is debatable, and a lot of people are going to probably yell at me and dislike my video, but I do believe that there is a methodical way to add some extra oomph to your portfolio with individual stock names, but you have to know what you're doing and you have to choose quality, right? So I do that myself, so I'm not against that. I like how he's got his S&P 500 allocation as IVV, which is a top S&P 500 ETF, and IVW. So we're going to kind of dive into those. So IVV is a core S&P 500 ETF where it's essentially investing in the top 500 companies measured by market cap, and it's a lot of names, you know, right? So we'll dive into that. This is, we're going to go to Ycharts, and this is what I use to do a lot of my fundamental research and just diving into ETF Holdings and things like that. It's really quick and easy. So IVV, let me start with this. There are three main S&P 500 core ETFs. IVV, which is very popular, VOO, which is Vanguard's version of an S&P 500 ETF, and SPY. A lot of people ask me, well, which one should I invest in? Well, it really, you know, they're all doing the same exact thing. So just look at the fee differences. The fee differences are not very large. They're all very affordable ETFs. SPY is going to have the highest fee, but it's still a low fee even with it being the highest fee. But if you are really, really torn, I say look at IVV or VOO because they're the lower fee ETFs for S&P 500 index funds. And so the holdings, you know, are going to be the basic holdings that most ETFs that are tracking major indices have. Apple, Microsoft, Amazon, Google, Tesla, you know, Meta, aka Facebook, and all these other names that you're probably very familiar with. So the other part of his S&P 500 tracking holdings is going to be this one, which is IVW. Okay, so he's invested in IVW, which is tracking the S&P 500 growth stocks. So when you think of a growth stock versus a value stock, a growth stock is growing revenues at high rates, usually double-digit rates, right? Let's check to see how the S&P 500 growth ETF has performed against the core S&P 500 ETF. So I'm going to use IVV and compare these, and we'll just do we'll do 10-year performance. And as expected, the growth ETF has outperformed the S&P 500 core ETF because growth companies are growing at higher rates. They're getting higher valuations attached to them. And so that's why a lot of people like to invest in growth so that they can get some outsized performance versus just the core S&P 500 companies, which it has a lot of value companies like banks and things like that in the core S&P 500 ETF. So this is why somebody would try to put some extra oomph in their portfolio with a growth S&P 500 ETF. Now, it's higher risk, right? It's more volatility, more ups and downs, because that's how growth stocks work. We're seeing that right now. They have a lot of volatility. So you have to be able to stomach that and take on that risk, have that risk tolerance for that volatility that can come with these. But overall, this person is young, it seems. They're 30. It looks like they are okay with taking on risk. And so this is probably okay for them. But for a lot of people, they don't like the volatility, the ups and downs, as you call it. Okay, so the next thing that Corey's invested in is VWCE, which Corey is in Europe. So this is going to be a ticker that you're not going to recognize, but it's basically a total world ETF that invests in not only US companies, but also international companies. Now, here's the thing with this one. I looked this one up, okay, and this is a Vanguard FTSE All World ETF. And what this is the European, version of a total stock ETF that you can get through Vanguard. And the top 10 holdings here are surprisingly not international companies. Apple, Microsoft, Google, Amazon, Tesla, Facebook, Nvidia, Berkshire Hathaway. I mean, this is essentially the same thing when you look at the top 10 holdings as a core S&P 500 index fund, and it's not really getting you that much international diversification. So something that this person could do to kind of improve their portfolio is, instead of VWCE, which they're already allocated to a lot of these top 10 companies, instead of doing that, they could think about something that's more international focused, ex-US. So look for an ETF that is investing in international companies excluding the US, because they've already got that US exposure. So that's something that they could do to improve this portfolio allocation a little bit more. Now, they also have JPEI, and JPEI is a income seeking ETF. Basically, what the managers are doing here is they are utilizing options contracts they're selling options to generate income. And options are a very complicated thing. I'm not going to dive into that too much, but essentially you can get some income in the portfolio by utilizing an ETF where the managers are selling options and trying to generate income and yield for you. So when you look at something like this JP Morgan Equity Premium ETF, the first thing that I would want to know is how much does this thing cost to hold? And the expense ratio is actually pretty reasonable. And I'm not saying this is a good or bad ETF for you. I'm just looking at this and analyzing this real time. But it totally depends on your investment strategy, your risk tolerance, your goals, just so many things. But this person has chosen to hold this stock. Likely they're looking for income. They're looking for yield. So when we take this and we compare this actually holds dividend paying stocks and options. And we can go to this fundamental chart option on Ycharts. And what I'm going to do is I'm going to compare the drawdowns that we've seen in this JEPI ETF versus the actual like an S&P 500 index ETF, which I'll use the SPY in this case. I could use any of them, IVV, VOO, it doesn't matter. And I want to go to percent off highs to show you that this is going to have a little bit less volatility than the core index, the core S&P 500 index. So the purple is the JEPI ETF, and the orange is the SPY, which is the core S&P 500 ETF. And you can see that when we see drawdowns, the S&P 500 ETF is going to have deeper drawdowns than this JP Morgan Equity Premium ETF. And basically what the managers are trying to do here is they're trying to generate some return via dividends and premiums from the options. And they're trying to also reduce volatility. So they seem to be achieving this in this ETF, but here's what you're giving up. Okay, you're giving up essentially return a little bit here because the JP Morgan Equity Premium ETF has not performed as well. And I'm looking at this on a 3-year basis. You could look, you can go back as far as you want to see this, but you can see that the core S&P 500 index fund has performed much better than the JP Morgan Equity Premium. And I'm actually going to put in total return here to include dividends, okay, because that's what we want to know. We want to know with the dividends or the income, whatever it's paying out, how has it performed? And it's the same story here. The same story is the S&P 500 has outperformed in terms of total return, including dividends. And when you look at the volatility between the two, you can clearly see that the JP Morgan is giving you less volatility, but it's not necessarily giving you all of the same return. So there's always going to be a trade-off in investing of something has to give. It's very difficult to get low volatility, high return, high yield, that's very difficult to get. So just keep that in mind, and without you having to take on a certain level of risk. Okay, so the next ETF in this portfolio was MGC. Now, here's what I'm going to say on this as well. The holdings here look strikingly similar. It's exactly the same as an S&P 500 core index fund. So as long as this person understands that they're getting a lot of exposure to those top big tech companies and that S&P 500 allocation, they're getting a lot of that here. So this could, be something where you could diversify into something like smaller mid caps, internationally. You could diversify more internationally. You could even diversify into other asset classes like bonds. But bonds are a whole different story right now. But essentially, this person is very allocated to the core S&P 500 top 10 big tech companies, and they just have it in different ETFs. It's just kind of coming in different forms, but it's really the same thing over and over again. So just keep that in mind. And sometimes this happens with ETFs. It's very easy to think that you're getting a diversified portfolio across not only different companies, different sectors in the market, but also people think that they're getting diversification internationally or across market cap sizes and things like that, but they actually may not be getting as much diversification as they think. So it's always important to look at the holdings of an ETF. But this may be on purpose. This may be purposeful because they want that much exposure to US big tech stocks. And if that's the case, they're definitely achieving that goal here. But hard to say exactly what the goal is because I don't know. So let's move to the crypto portfolio. The crypto portfolio makes up 35% Bitcoin, 35% Ethereum, and 20% Solana. And then another 10% of whatever, it says other, random coins. So I like this. I like this a lot. Not only is the crypto allocation a reasonable crypto allocation for the entire portfolio at 15%, that's not low, okay? But that's not crazy high risk high either. So it's reasonable for someone that's willing to take on more risk. If you're not willing to take on more risk and volatility, that's not reasonable. So it totally depends. But I like how they are going for the top coins, okay? They're going for Bitcoin, Ethereum. Those are the largest allocations in the crypto portfolio. Those are the largest cryptocurrencies out there right now, the most popular at least. And so I like that they're just focusing on that quality crypto instead of just a bunch of, Dogecoin and all of these other little coins that they may not even survive. So I think that this is a well-constructed crypto portfolio. I don't really have a lot to critique here. And then let's move to the cash position. So the cash position is 25%. Now, I want to talk about cash for a second because cash positions are very personal. A lot of people are afraid to have too much cash because they think they need to be investing and have it working for them. But keep this in mind. This person in particular was saving for a new house. They're planning on buying a new house in the next 3 years. That's why they have a larger cash position. Totally fine. I think that people get too hung up on the cash. I think this is what you need. You need to make sure you've got your emergency fund in cash, right? And then you also need to make sure that not only do you have your emergency fund, but you are saving for your short-term goals with cash or a high-yield savings account. Not a risk vehicle, right? You want to be saving for things like a down payment or a wedding or a new roof for your house. You want to be saving that, and you don't want to put that money at risk, right? Because if you put it at risk and you put it in the markets, it's going to be very troublesome when you go to pull it out. And if the market is in a downturn, you're going to come out with less money than you thought, right? For your short-term goal. That's not good. We don't want that. Don't worry too much about the money that you're saving for short-term goals. Put it in a high-yield savings account. Let it sit there until you need it. Save it. Let it, continue to build. And don't overthink that. I think that it depends on your situation how much cash you should have. If you've got a business that you're running and you need to have a business emergency fund in addition to a personal emergency fund, right? If you have children and unexpected expenses come up with kids all of the time, if you're unsure about your job situation and you switch jobs a lot, or you're worried about losing a job, then you want to have a nice buffer of cash just in case something happens. So don't overthink that. I think that this person sounds like they really know what they're doing in terms of do-it-yourself investing with their allocation overall, the stocks, the crypto, and the cash. And it looks like they don't have debt. They're dollar cost averaging into these things. And so sounds like they've been learning a thing or two from the Skill Incubator investor community is what it sounds like. So this portfolio may work for Corey. It sounds like he's a young guy with high risk tolerance. Sounds like he understands, what he's gotten himself into here. Just keep in mind that stocks and cryptocurrencies are the highest volatile assets out there. Crypto is the highest. It's crazy. So for Corey, this may work and he can stomach the drawdowns and seeing his portfolio down a little bit more than maybe somebody that's invested in more bonds and less crypto or something like that. But for a lot of people, they really may not be able to handle a portfolio that looks like this because of the drawdowns being so deep when they come. Crypto has been notorious, specifically, just talking Bitcoin alone, it's been notorious for having very deep drawdowns, 50% plus drawdowns. In fact, let's look at the Bitcoin drawdowns historically. If we go back, we can see that these drawdowns can get anywhere from 40%, 50% to all the way, almost all the way down to 100%, almost. So look, these are very, very deep drawdowns. Right now we're showing Bitcoin at around a 40% drawdown from the highs, and that is not small. If we saw that in the stock market, people would be, freaking out. It would be the end of the world. Okay. But for Bitcoin, it's normal. So this is what I mean. The higher the allocation to crypto that you have, the more you need to be able to stomach this type of volatility. Okay, so let's move on to the next portfolio, and this is from James. James did not give me any information except for 2 tickers, and they are both mutual funds. So mutual funds were like the OG, fund, and then ETFs came into town, and they're the cooler cousin of mutual funds. They're more affordable, they have better tax structure, and they're just overall way more popular now than mutual funds. FXAIX is the first ticker, and this is a Fidelity Core S&P 500 mutual fund. Very low expense ratio. Remember, the first thing you want to do is look for that cost to hold that ETF or mutual fund. This is basically nothing. Very affordable. And this is essentially just holding the same S&P 500 index companies. So it's getting you that S&P 500 core exposure, and it's just in a different little bit different of a version. It's just a mutual fund over an ETF. This is very common now where mutual funds are doing, just like ETFs, they're doing low cost, they're indexing just the same, and so it's pretty great. So this is fine. And then the other part of the portfolio is FUMBX. And FUMBX is a mutual fund with, again, a very low expense ratio. And what this is it's holding short-term treasury bonds. So bonds are going to be lower volatility, lower risk, but lower return. So a lot of people put bonds into a portfolio to try to level out those, ups and downs and make that volatility lower overall. And this one is actually pretty smart right now because we're expecting interest rates to rise. So when interest rates rise, you want to have short-term bonds because you want them to mature so that you can rotate into a bond that is paying a higher interest rate because interest rates are rising, right? We're expecting interest rates to rise. So essentially, bonds mature, okay, done with that bond. Let's get into a new bond that's going to pay a higher interest rate. So bonds carry interest rate risk because we don't know all the time what interest rates are going to do. And so this is actually a smart choice for right now. But once interest rates start to rise, it could make sense for somebody to move from more of a short-term bond exposure into a longer-term bond exposure to lock in that higher yielding asset, especially if you don't expect rates to go a whole lot higher. As interest rates go up, bond prices actually go down because people are essentially, if you think about it in the most simple way, people are selling their bonds because there are opportunities to get a bond that's paying a higher yield, right? Because interest rates are going higher. Bonds are way more complicated than what I just said, but I'm just trying to get you to actually understand how the price moves when interest rates are rising or declining. So as interest rates are rising, you're going to probably see bonds go down and then vice versa. As interest rates are declining, the prices of those bonds are going to go up because people are going to want those bonds because they're locked in with a higher interest rate than what they could get as yields are going down. So yeah, bonds are complicated, but essentially this person has mostly an equities allocation and they are all US stocks. They're basically all US stocks, large caps, essentially. So there's really not a lot of diversification here outside of the US and outside of big tech and larger companies. There's no small caps, no mid caps. There's no international companies in here. So something that this person might be able to do to improve their diversification is exploring maybe getting some international exposure through ETFs outside of the US and maybe even broaden their exposure from just having large caps to having mid caps and small caps as well. So sometimes small caps do better than large caps. You never know who's going to win the race, right? So it just depends. I think 2020 small caps actually outperformed large caps. Overall, that's pretty much all I can really say about this is a higher risk portfolio because it's mostly equities and it's not extremely diversified. Not that that's, this person may just want to be in the US and large caps, and that's fine because that's performed well. So a lot of people have a bias towards that because that's what has done well. But I am a proponent of diversification, not only across investing styles, but also across geographical regions and also across sizes of companies, small caps, large caps. So that's kind of how I like to do things. But okay, so I hope that you found this video helpful. If you want to slide into my DMs with your what you're investing in, then maybe you can be the subject of the next video. So don't forget to like this video if you found it helpful. subscribe to my channel, please. Let's help the algorithm get me out there so more people can learn how to dissect a portfolio and research ETFs. Don't forget, your portfolio construction is going to depend on your goals. It's going to depend on your risk tolerance. It's going to depend on a lot of things. So this is, just general here in nature, and you really have to get familiar with your own situation. I do teach how to research stocks and research ETFs and construct a portfolio the right way in my training program. I highly suggest you check out the link in the description and see if that could be a fit for you if you're looking to learn how to manage your money much better, learn how to save on taxes, and learn how to construct a portfolio for the long run. And I'll see you in the next video.